What's good, everybody? It is nice to be back, and thank you all for watching once again. So, as you can tell by the title, we're going to discuss SVB and what happened. Basically, throughout the news, we've all heard about what's going on with SVB and the bank run, and basically ultimately the bank collapse, and not just affecting SVB, but other banks around the world, pretty much. I think there's something going on with European banks too. So it's just not really concurrent to only the U.S. It's a worldwide trickle-down effect from what's going on. So in this video, I'm going to basically discuss what is SVB to give you guys a background, discuss what happened, so how basically the bank run happened, what caused it, and discuss what we can do as just, regular day folks who put our money into banking institutions, what we can do to be more secure, right? And basically what I do and the precautions that I've always been taking, and I can give some of that information to you guys as well. Hopefully that is a benefit to everyone who's watching the video, right? So basically, I'm going to read off an article here from capital.com and another article here from, I believe, euronews.next. So credit goes out to them. Thank you guys for your amazing article. So basically, we're going to talk about what is SVB, right? So Silicon Valley Bank. So Silicon Valley Bank was set up in 1983, et cetera, et cetera. The company was designed, as its name suggests, to serve the needs of tech companies at a time where the market for computers was still, if not in its infancy, and then in the fairly early parts of its overall development. So the organization grew and grew, opening offices across the U.S. And basically, throughout what I just read, is that SVB is a bank that primarily deals with not necessarily large tech companies, but with tech companies in general. So that can be like a small tech company, or maybe a mid-sized, say even a large tech company, right? So they deal with technology. So just by that happenstance, a lot of these tech startups, they require a lot of funding, right? So they need a lot of money in order to get this, whatever they're trying to provide off the ground, basically. So, and they require a lot of money, but they also can make a lot of money or put a lot of money into the bank. So that's already another problem, right? So just by this explanation, we already know that SVB is actually a pretty large bank, right? That holds a large amount of deposits from tech startups and tech companies, which can be in the millions, if not a billion. You never know. So just by that, we can see the scale of this event, and we're going to keep reading. All right. So now we're going to talk about Silicon Valley Bank collapse and how that happened. So the article states things started to go wrong in 2022. While the previous few years had been pretty good, etc., the tech industry, as people relied more on online companies during, COVID-19. So basically, normally this would have been a pretty good investment if it wasn't for the growing interest rates that we have in today's economy, right? So because of the Fed is increasing interest rates by 0.25, 0.5, and because of whatever the SVB was, well, the bonds actually that they were allocating people's funds into, when you have higher interest rate, the bond prices tend to decrease. And that's how they're losing money. But I don't want to get too ahead of myself, right? So in turn, this caused some business to worry about the overall security of their deposits within SVB, which led them to withdrawing their money. So, okay, perfect. So now I'm going to switch over to the other article to give us a little bit more information on the U.S. Federal Reserve and their increasing of the interest rates, right? So SVB was hit hard by the downturn in technology stocks, as we're all witnessing. This has been going on for almost 2 years now, right? Over the past year, as well as the Federal Reserve aggressive plan to increase interest rate to combat inflation. So that's what the Federal Reserve does, right? They try to combat inflation because people are borrowing a lot of money, right? So the bank is loaning a lot of money at a lower interest rate because the interest rate was extremely low in 2020 and 2021. So banks could loan out that money at a lower interest rate to where people like you and I, companies, would then borrow that, take that loan out, and then they would pay a pretty low interest rate, right? But now that the Fed is increasing interest rate, making it hard for people to borrow money, i.e. tech startups, i.e. regular people like you and I, sometimes banks may have difficulties in really processing loans and trying to find the right people to take on these loans because the interest rates are higher now. And there are less people who are willing to borrow, who are willing to borrow money at such a high interest rate. So the bank bought billions of dollars worth of bonds over the past couple of years, using customer deposits as a typical bank would normally operate. So this is not only specific to SVB. All banks, like you can look through my videos, I've said this before, all banks, when you deposit your money, they take literally 90% of your money and use it for whatever purposes, i.e. maybe giving somebody a car loan, maybe giving somebody a mortgage loan, maybe investing your money into the stock market, into bonds, into even crypto. Whatever they want to do with your money, they are able to do so. And they're only required to keep 10% of your money in the actual physical bank. So think about that. If everybody wanted to take their money at once, it would not be possible because they don't have the liquidity for that, right? All their money is stuck in assets. And then for their scenario, it was depreciating assets because the Federal Reserve was increasing interest rate. So, and that's the problem. These investments were typically safe, but the value of this investment fell because they paid lower interest rates than what a comparable bond would pay if issued in today's higher interest rate environment. Okay, usually that's not an issue because banks hold on to these for a long time unless they have to sell them in an emergency. And what happened is because tech companies are not able to really borrow as much as they could before because of the higher interest rate that I discussed earlier in this video, that they're using more of their own liquidity to pay off employees and to pay off whatever expenses that these tech companies have because they're not able to borrow that fund at a lower interest rate. So they have to use more of their own liquidity, which is held in the bank, so their own cash. So because of that, SVB then had to sell those bonds that were held long term at a loss, basically. So they had to sell those bonds at a loss in order to have money to basically to pay off these tech companies who are extracting their money from the bank in order to then pay for people's payroll and expenses. So because SVB customers were largely business and the wealthy, they likely were more fearful of a bank failure since their deposits were over $250,000 or the U.S. government imposed limit on deposit insurance. So because of this, word got around to people, and that basically caused, hysteria, which is, which I wouldn't say it's incorrect because they weren't liquid. SVB was not liquid, and that caused people to then take out money from their bank, all the money that they possibly could, and that then basically caused a bank run because the bank itself did not have enough money to cover every one of their clients, right? So SVB did not have enough money to cover all of their clients because they made pretty much terrible investments, right? So they made a bad investment at a wrong time because they weren't prepared for the Fed to increase interest rate as dramatically as they have been doing in this year. So, that's pretty much all on SVB. And this is not just something that's only to them. Like I said, all banks pretty much do the same thing. It's just that a other banks kind of focus on a little bit of a smaller type of customer base and things like that. It really just is really worse for SVB because they deal with large companies, multi-million-dollar companies, that if they try to take all that money out of their bank, it causes some issues because they don't have that money, basically. So what can we learn from this situation, and how can we, as the, just an average Joe, what can we do in order to make sure we're not in a situation like this, right? So, as we all know, the money that we put in banks is insured up to $250,000, so which is great, right? But if you have more money than that, or if you're just a person like me who's more cautious, you most likely do need to open up more than one bank, right? So you want to have numerous banks. If you are a extremely wealthy person, you want to have your money allocated through numerous banks, right? So I have about 3, and I'm not the wealthiest person in the world, but me having 3 spreads out some of the risk that one of the banks I'm in could have a bank failure like that, right? So a lot of you who are watching, take that into consideration. Please have multiple banks, right? I actually have a cash account with Fidelity because I love Fidelity. That is the institution that I use for my stocks as well. So I love Fidelity. I use their cash account, and I have 2 other banks as well. So that's what you can do. Another thing you can do is invest more, right? So into the stock market. But the same thing applies. You want to have multiple brokerages, because if you are a person who has a lot of money in your stocks, I think they're only insured up to, I believe, 500,000. I believe so. But yeah, you want to have multiple brokerages, because if one brokerage collapses and you have more than $1 million in that brokerage, it may be difficult to get all that money back that's in there through that brokerage, basically using the money in a way that is not the best financial decision, right? So, which can happen because you're putting your money into their hand, even though it is slightly different where brokerage is, that could possibly happen. So it is smart to have numerous brokerages as well, but definitely invest more of your money. You don't want your money sitting into a bank account for too long. Of course, you can have money sitting in the bank, but just make sure you're getting a good amount of interest on the money that you're putting in. So with Fidelity, their cash account offers, I think, almost 3% interest because of the high interest rate, or no, it's 2.33, I believe, from the Fed. And I'm okay with that. I like that better than 0.03. And I like that better than some dividend yielding stock that offers 2% on its yield, and the price can go up and down. I feel like it's more, it's with the Fidelity and the interest rate that they're using. For me, I appreciate it. So that's a little 2 cents for everyone who wants to join Fidelity. They're giving out pretty good interest, and that's how you can capitalize off this high interest rate environment, man. So another thing is you want to buy more commodities, right? So assets, commodities as in gold and silver. So maybe with each paycheck, if you can, allocate a portion of it to buying a 1/10 gold coin, or buy a full silver coin and just keep it somewhere safe. Because that is a store of value, believe it or not, commodities, gold and silver. And it's really great to hedge against all this crazy stuff that's going on. And last but not least, Bitcoin, right? So Bitcoin is another good one. I like Bitcoin, and yet I'm not like super overly invested into Bitcoin. Like, it's not a large portion of my investment, but maybe you guys can do 10% of your monthly income into Bitcoin, maybe less, maybe 5%. But it is up to you, and just work that way. I like Bitcoin because I have a card that I got from Coinbase so I can spend my Bitcoin, spend my cryptocurrency, in general, any cryptocurrency I have, and use it, Solana, Cardano, right? So Bitcoin is a good one as well. Yeah, it goes up and down. The cryptocurrencies go up and down, but I like to also invest into that as well, just because, you never know when you'll need them, right? And this goes to show you, if you have some money allocated in Bitcoin, of course, you will be upset if you lose your money, of course. But it just helps you know that you have money spread over in different places, maybe not too much. It will help you sleep a little better at night. So all in all, the people pretty much aren't to blame. They did nothing wrong. They just put their money into a bank. And it's because of the way our financial system is ran, and we don't have anything backing the fiat currency. The banks honestly didn't really do anything wrong as well, because this is just how banks operate. They use our money and leverage it. That's just what they do. So all in all, it was just an event for catastrophe. And you as an American citizen, you as a person in general, just need to be able to take better control of your finance.